Reliance Q1 FY14 results were announced today. Net revenues were down 4.6% YOY and they were higher by 4.1% Q1Q. They were at 87,645 crores. However, on the operating margin front, the company delivered 8.1% against our expectations of a 7.6%, and they were higher by 73 bips on a Y&Y basis, but they were down 122 bips on a sequential basis. The PAT was at 5352 crores. This was higher by 19.7% Y-on-Y basis. This was slightly higher than our expectations of around 5260 crores. The key reason for this outperformance was the beat at the operational level as well as substantial jump in other income, which was higher by 33.1%. Coming to segmental performance, refining segment performance was better than our expectations, primarily on the margin front. While GRMs at $8.4 per barrel, in line with our expectations of $8.5 per barrel, the EBIT margins for the segment came in much higher than our expectations. The throughput, however, was lower than our expectations and was at 17.1 million tons. This is in comparison to 16.1 million tons in the previous quarter. Mainly, the previous quarter number were lower on back of the plant shutdown. Coming to the petrochemical division, the production was lower than our expectations. It was at 5.3 million tons. We were expecting it to be around 5.5 million tons. EBIT margins for the segment came in lower than our expectations. We were expecting it to be around 9.4%, while they delivered 8.6%. Coming to the oil and gas segment, KG-D6 production was at 15.5 MMSCMD, a fall of 52.9% on a Y-on-Y basis. This led to a fall of 42% fall in revenues, with the depreciation coming in for some benefits here. As mentioned before, other income was at 25.4 billion, which was much higher than our as well as the street expectations. And we note here that it now contributes to around 38% of the PBT. What we are really doing with the stock now is that we are revising our rating to market performer, given the fact that stock has witnessed sharp up move since the announcement of gas price hike. And the key things to be tracked for the stock are the cash. Currently, the company is sitting on a cash of 90,000 crores. How does it utilize it with regards to E&P acquisitions or investments into the petrochemical divisions? These have to be watched closely. Going ahead, refining margin performance is likely to be flat for this year. We expect RIL GRMs to be in the $8 to $9 range for the rest of the year, and for FY15 we are expecting it to be around $9 to $10. For petrochemical division, we expect an improved performance in the later half of FY14 and FY15 as well. This will be mainly led by new capacities commencing for Reliance Industries, which are highly integrated as well as will be able to earn better margins. Another important point would be revival in KG-D6 production. The company has been quoted that it would be a revival will start from FY17. Earlier than that, revival would mean a push up for the stock as well as valuations. At current levels, we feel that the valuation upsides are limited, and hence we retain a market performer rating on the stock with a target price of 950. Thank you.